When you sign the paperwork for a new home, the sheer volume of documents can be overwhelming. Amid the excitement of getting your keys, it's incredibly easy to overlook the mountain of fine print. But buried deep inside those documents is a sneaky monthly fee that costs millions of homeowners thousands of dollars a year. If you put down less than 20% when buying your home, your lender almost certainly added private mortgage insurance, commonly known as PMI. This fee typically ranges from 0.5 to 1% of your entire loan amount per year. Let's break down what that really means for your wallet. On a $400,000 mortgage, a PMI rate of just 0.5% means you're paying an extra $2,000 per year. If your rate is on the higher end, say 1%, that number doubles to $4,000 a year. That translates to an extra $200 to $300 tacked onto your payment every single month. And the worst part? This insurance does absolutely nothing for you. It isn't homeowners insurance that protects your property from damage. It strictly protects the bank in case you stop making payments. You're paying to insure their risk. But here is the real trap. The bank will never reach out to tell you when it's time to stop paying it. They are perfectly happy to keep collecting that fee for as long as possible. Under federal law, lenders must automatically terminate PMI, but only when your loan balance is scheduled to reach 78% of the original value of your home. This could take many years. However, you can legally request to cancel it much sooner. The exact moment your home equity hits 20%, which is the same as an 80% loan-to-value ratio. Thanks to rising home values, your property might already be worth enough to clear this threshold today. Your equity comes from two sources: the principal you've paid down and, crucially, the market appreciation of your home. To be eligible, you must have a good payment history and no second mortgages, like a home equity line of credit. So, how do you actually get rid of it? First, call your mortgage servicer. This is the company you send your payments to each month. Simply tell them, "I am requesting an early cancellation of my PMI based on my current home equity, and I would like to schedule a new appraisal." They will then order a home appraisal to confirm your property's current market value. You'll have to pay for this, typically between $300 and $500, but it's a small price for potentially saving thousands every year. But beware if you have an FHA loan. FHA loans don't use standard PMI. They use a mortgage insurance premium, or MIP. Unlike conventional loans, for most FHA loans originated after 2013, MIP stays on your loan for the entire 30-year term, regardless of how much equity you build. The only way to escape the FHA insurance trap is to refinance your mortgage into a conventional loan once you hit 20% equity. You'll need to calculate if the closing costs of the refinance are worth the long-term savings from eliminating MIP. There are other pitfalls to watch for. If you've recently been in mortgage forbearance, your lender may require a period of consistent payments before allowing you to cancel PMI. Also, some lenders have stricter rules, known as overlays, that might require more equity than the federal minimum. Want to do a quick check yourself? It's simple. First, find your current mortgage balance on your latest statement. Then, get a rough estimate of your home's value from online real estate sites. Divide your mortgage balance by your home's estimated value. This gives you your loan-to-value, or LTV ratio. If that number is 0.80 or less, you have at least 20% equity and it's time to make the call. For example, if your remaining loan is $300,000 and your home is now valued at $380,000, your LTV is 78.9%. You're almost there. But if it's valued at $400,000, your LTV is 75%. You've cleared the hurdle. Wiping out a $250 monthly PMI fee instantly saves you $3,000 every single year. That's money that goes directly back into your pocket, not the bank's. Stop letting the banking system quietly bleed your bank account dry. Take control of your mortgage. If you want to learn how to audit your bills and protect your wealth, follow and subscribe Finance Simplified for more such tips.